Buenos días, soy Eduardo Calderón, director de operaciones en la Bolsa Institucional de Valores, y quiero darles la bienvenida a este panel en el tercer día del Viva Forum que hemos titulado Tecnología y Futuro. Viva tiene un compromiso permanente con la tecnología que viene desde antes de salir a la luz, específicamente desde que apenas era un proyecto de Cencor, el grupo empresarial que hizo realidad una segunda bolsa de valores en México. Para que Viva lograra ser una de las bolsas más rápidas y confiables en el mundo, se realizó una importante tarea de implementación y una fuerte inversión en infraestructura, tanto de servidores como de redes, capaz de darle respaldo a un producto tan avanzado como es nuestro sistema de negociación. Con orgullo les comento que desde su implementación no hemos tenido ninguna falla técnica en el sistema de negociación Opel y se ha logrado tener el 100% de disponibilidad desde que comenzó Viva. Además, hemos seguido invirtiendo en tecnología e infraestructura, lanzando nuevas funcionalidades para el beneficio de nuestros clientes y del mercado mexicano. Con esta apuesta por la tecnología, Viva logra alcanzar una de sus metas fundamentales: fortalecer el sector bursátil en el país y que más mexicanos puedan encontrar beneficios en el mercado de valores. Antes de comenzar con el panel del día de hoy, quiero comentarles un par de cosas relacionadas con la transmisión del Viva Forum. Todos los paneles del Viva Forum tienen traducción simultánea inglés-español, por lo que si ustedes desean escuchar nuestros paneles en otro idioma, lo único que tienen que hacer es seleccionar el idioma de su preferencia en la barra inferior de su pantalla, justo al lado del módulo de preguntas y respuestas. Let me repeat that in English. All Viva Forum panels will have simultaneous English-Spanish translation, so if you want to listen to our panel in other language, all you have to do is select the language of your choice in the bottom bar of your screen, right next to the question and answer module. Speaking of which, at the end of the panel, we will have a space available for questions open to you, our audience, that we'll address to our panelists. So if you have any question or comment during the panel, do not hesitate to write them in the question and answer module. Sin más preámbulo, quiero agradecerle su presencia en este panel a Natalie, Ronan, Daniel y a nuestro moderador Luis Carballo, quien actualmente es asesor senior de tecnología para Cencor y Viva. Ingeniero electrónico por la Universidad Autónoma Metropolitana y cuenta con maestría en Tecnología de la Información y Administración por el ITAM, así como Redes y Sistemas de la Información por la Escuela Nacional de Telecomunicaciones de la Bretaña. Luis, te cedo la palabra.
Muchas gracias, Eduardo. I'll switch to English. Thank you all for being here with us today. I'm very pleased to introduce to you our panelists for today. Natalie Samarco is the Global Head of Sales Readiness for Innovation, who works with customers and sales teams to implement full understanding of the breadth of emerging technologies guiding financial services. Natalie works closely with the Artificial Intelligence and Machine Learning team in Refinitiv Labs, the innovation arm of Refinitiv, in facilitating partnership and new business opportunities. Natalie believes exploration within innovative technologies and data management are an essential part of financial services and related industries, and has worked extensively in the global markets, having spent nearly a decade in Asia. Ronan Ryan, president of IEX. Ronan is responsible for strategy and decision-making related to all of IEX's client-facing businesses. As part of that role, he focuses on building and strengthening relationships with external stakeholders, including broker-dealer members, institutional investors, and companies. Prior to co-founding IEX, trading strategy at RBC Capital Markets, where he used his prior experience in network hardware and co-location technology to generate client-facing solutions. Daniel Seal, Chief Product Officer at KX. Dan is Chief Product Officer at KX and based in London. Before joining KX, he spent 16 years developing and running global market data and analytics systems for Tier 1 financial firms, including Deutsche Bank and Merrill Lynch. In his current role, he oversees KX product strategy, as well as advising clients for multiple industries on their data management, analytics, and cloud versus on-premise needs. I am grateful for moderating this panel today. I want to thank our panelists for their time today, knowing they're in different countries and time zones, and I'm sure this will be a very rich discussion considering the experience of all of you. Technology is the core of the exchanges and plays a central role in the markets, enabling innovation, strategies, and new ways to operate the markets. We will be talking with the panelists who will be giving us their vision on technology and current trends. Having said that, I would like to start off this panel with questions for all of our panelists. And after that, I will be doing individual questions for specific panelists. However, I would like to encourage the rest of the panelists to chip in if they have any other comments around that. So the first question for all of you is, what technology trading applications on exchanges, data vendors and clients do you foresee due to COVID? I mean, COVID is in our daily lives now. So this is going to be changing some of our technology, the way we work and the way we interact with clients and customers and vendors and stuff. So what is your take on technology on that side? So Natalie, you want to start, please?
Sure, absolutely. And you're absolutely right, Luis. COVID is part of our lives. Before March, I like to call those times the old times, and now it's the new times. So I beg your indulgence with that. But pre-COVID, in the old times, we were seeing very tight and dense market. In COVID, starting in March, we started seeing high levels of market volatility, evaporating liquidity, and this resulted in large swings, record number of volume and large swings in trading. On our Ready EMS system by Refinitiv, we saw more than double the usual trading in March. What we're seeing now, it's not quite a secret, but due to the increased number of volume in trades and the responsiveness needed to respond to the market, we saw a shift from passive management of funds to active management of funds, basically because traders needed agility and flexibility of the active management. It was more able and more equipped to handle that market volatility.
Yeah, and I think on the technology side of it, the ingest of that data, which is really where we specialize, it's that the initial spikes that were caused by COVID, that volatility. If you look at the VIX, you could almost draw a data volume chart right next to it that would track it almost one for one. I think talking to some of our sort of T1s that are capturing this time series all the time, the initial spikes around COVID were almost global records. They saw Brexit, actually. I guess being from the UK, I can get that one in early. That was I think that was still the record day. But it's, I think the sustained volumes and throughputs and the sustained pressure on technology backbones, even now, the data rates are 2 or 3 times what we were seeing pre-COVID, and all of that is really just uncertainty and the volatility that creates in the markets. So I think I would also say that the financial markets, perhaps more than a lot of other verticals that we see, are well equipped to deal with a lot of this. 2003, 2008. Various, global incidents, that there's good due diligence in the financial markets. People do a lot of work to ensure stability of their platforms, the exchanges working hard, the data vendors working very hard on their global networks, people trying to ensure that they can design systems that are sustained. But even so, when you see a 9x spike in volume on a day, that is asking an awful lot of any system.
Cool. And thanks for the invite to this panel. Happy to be here and happy to be on with these panelists. What I'd say, and Natalie's comment of the old times is pretty funny because that's sort of the way I look at it. New times are not all bad when you're an exchange. More volume is more revenue, but it was a tricky time back, especially the week of March 16th was tricky. But I thought what I'd touch upon is kind of 2 things from an exchange that we've seen that's pretty interesting. So in the U.S., I'm mainly focused U.S. equities. U.S. equities now, close to 50% of volume is happening off exchange. And that has spiked dramatically. I remember from December 2018 to December 2019, off exchange volume went from about 34% to 39%, and people were freaking. It's close to as high as 50% right now. And why that's important to me as an exchange person, as well as our broker-dealer clients, is that off-exchange volume, much of that has been done as retail. And retail in the US, a lot of that retail volume is inaccessible. So now you have brokers running algorithms to react to volume triggers, and volume is hitting the tape, but that volume is inaccessible. So there's a huge terminology in the equities industry now on inaccessible liquidity. And off-exchange volume, again, in the US is reported on a T plus 14 day or a T plus 28 day window. So this is not something that algorithms can interact with and react with. So now there's a lot of talk from the regulators about potentially having off-exchange volume reportable real time. So if volume is trading in a broker's dark pool versus retail trading that you can't interact with, it's good to know at least what percentage is inaccessible so that these triggers on the broker's algorithms are not causing them to blast the stock. The other thing that I thought was really interesting, and I'm not sure if you guys have seen the sort of drama going on around this, but due to COVID, obviously, and I'm not making light of this whatsoever, but many states in the US have been impacted negatively. Their budgets are destroyed. And New Jersey in particular, where in the US you have stock exchanges like New York, Boston, Chicago, Philadelphia, all of them are in 4 buildings in New Jersey. And now the New Jersey government is looking to institute a financial transaction tax, they're calling it. And as such, and how it relates to technology and maybe an implication to COVID, so it might be a stretch of an answer to your question, Luis, but many of the exchanges, including us, are looking at, will we have to move out of New Jersey? Will it become too problematic to trade in New Jersey? Because the exchanges themselves, if you look at it, we capture fractions like single digit 1/100ths of a penny per share. So any tax that you tax an exchange is obviously going to roll downhill. We can't eat that. We'd be underwater on every share. So who does that roll downhill to? In the end, it rolls down to the investors. So there's a lot of interesting, I'm back on the phone with data center providers now again, getting colo quotes in Chicago and Dallas, and it's pretty crazy. So I'm hoping rationality will win out, and I can understand certainly why the state of New Jersey would be looking for more tax money, but they might be barking up the wrong tree in this one. So we'll see. But it's been a very strange implication of COVID so far.
Well, that's a tough one. If they really want to start charging taxes on specific transactions, it's going to move all the market around, and the current
correct
of the market is going to be moved and shifted to a different dimension, I would guess.
Correct. And it gets very messy because you have a lot of pensions from different states trading because the exchanges are in New Jersey. And now New Jersey is taxing the teacher's pension of Texas when they trade in New Jersey. So stand by. If you like drama post-election, maybe this will be more interesting.
Well, it's only 2 weeks. 2 weeks to go.
Yeah.
Well, thank you. Good takes on that one. So the next question is also for all of you. It's so you said clearly the first weeks of March was peak of messages and trades due to COVID and all the volatility. So all that stress on the systems and markets after those events, how does that change your current technology roadmaps? So, Ronan, you want to start on that one?
Yeah. No, so particularly the week of March 16th, I guess it was the most operational risk that stock exchanges and off-exchange dark pools have seen in the U.S. ever. We've never seen message traffic like this. And particularly that week, many dark pools that are not regulated to the same extent that stock exchanges are failed over. And we saw an initial spike in not just volume, but our market share actually increased pretty dramatically as a result. So what that said to us, and actually Dan from KX, we use KDB and it performed extraordinarily well. And we heard that KDB did, not to give you a plug, but it really is the truth, because we had designed our system and it held up. I will tell you, just truth be told, and I've told clients this, we had no issue with our trading platform whatsoever, but we had to push some of our systems to handle the throughput. So our reporting was delayed and stuff like that. But I think what it's done from at least an exchange standpoint is you always load balance. Obviously, that's just like an exchange 101. But I think as a result of this, we've really looked into load balancing and why. Because what's really important to understand, again, from running an exchange, but particularly for our clients, is a bottleneck of messaging throughput equals more latency and non-determinism. And clients do not like that. Any kind of uncertainty, the whole world was uncertain, but latency uncertainty is a real no-no. So I think what we've done is we've chucked more, Dan would like to hear this, more KDB cores at this. We've added more equipment, and we've definitely load balanced. And we've really tried to now, like intraday, we'll change our load balancing based on the previous day's, trading, as opposed to what I think a lot of people prior to this had done is look at the rolling 30 days. And I think people are just reacting much more dynamically going forward. So it's probably been a good thing for the reliability. And I will say, not just IEX, all stock exchanges fared very, very well. There was no issues with any of the stock exchanges. And in fairness, most every broker's dark pool performed pretty admirably through this. So I guess it was a good test.
Well, I'm very pleased to hear that we didn't let you down, Ronan. That's
no.
music to my ears. Yeah. But yeah, I mean, really, just kind of picking up on some of the points in there. It's really about the volatility is not going away, right? 2008 was kind of the first big one. We've had a number kind of in the middle, and it's still going. Whether it's pandemics or global events, they all have a big impact and spike regular trading and volumes like that. And it's the ability to react quickly to that where we're focusing a lot of our work heavily now. Cloud is part of this, but also just generally the ability to scale dynamically. And allow these systems to burst, to increase their capacity whilst you need it, and come down and reduce their compute footprint at the same time. For us, there are particular challenges around highly stateful systems where you've got a large amount of data that you're dealing with. So there's lots of challenges there. There's lots of new technology as well to help with this kind of thing. So a lot of our focus now is on ensuring that we can help all of our clients as much as we can and give them the software infrastructure that they can then build on to be well equipped for when these events keep happening. So that's where a lot of our work is. Does it really change the roadmap? I don't know that it really does. I think everybody's been working hard for quite a long time in this direction. As Ronan was saying, the exchanges all fared very well through that, which is a testament to the work that's been done over the last decade or so around best practice and dealing with these kind of events. And the financial markets, particularly well equipped to deal with a lot of the challenges of COVID, much more so than some of the other verticals like retail. We don't all need to be there. The exchanges aren't a physical floor anymore, as we all know, with guys shouting at each other. So, technology allows us to deal much more easily with some of these challenges.
Right. And as it relates to Refinitiv, I agree with Dan. Our roadmap was quite well built out, and I'm happy to say that we'd been working on these technologies for some time, making sure that they were robust to deal with upsets. But I believe, as both Dan and Ronan said, this is an unprecedented time, and all companies had to shift in some way, at least to respond. If you didn't, that would arguably be the wrong move. In the US, we're seeing factories shift their production manufacturing. We're seeing labs that manufactured something else working on vaccines. For Refinitiv, I work closely with Refinitiv Labs. It's a group of about 50 individuals globally, 3 different locations. And as a large data provider, we have all of the data that would have been especially beneficial to financial firms. And so what we did immediately was work on a project, and we got it out quite quickly, called the COVID News Tracker, where the customer can ingest news, trends, marry it with information about their portfolio. It's in our Refinitiv Workspace product now, and we got that out quite quickly. So as a response, I would say 1st of January, that was not on our roadmap, but we pivoted quite quickly to get that out, and we already have customers working on that and helping us and giving feedback on that. So that's how we pivoted. And now that we're all a bit more socialized to this world that we're living in, the new times, so to speak, there's much more of a focus on how can we provide this end-to-end respond to the end-to-end workflow with Refinitiv, make sure that there are limited security gaps within that, making sure remote working is quite fluid, because it seems like many of us will be remote working or have the option to remote work in stops and starts, given whatever situation. So we're focusing on that, and I see in the industry that cloud technology and whatnot is being invested in heavily to ensure the fluidity of work. I don't know how much work or how many work hours were lost between the group here or our listeners, but it's suffice to say that technology is the reason that we could at least get up and running and still be here today, even to watch this conference that we're on. So roadmaps have shifted, but not completely changed.
Yeah, and the financial markets in general are used to these stresses and spikes and extra volume from one day to another. I think that has helped the past for us to get used to that and prepare our systems in order to deal with all these kind of volatility. I know investors don't like that because we have excess capacity in general, but that's what we need for days like these, and it's going to keep on going. And we need to keep being prepared for these spikes that can happen anytime. BIVA had the same thing. We have, I know BIVA has excess capacity. They always test their systems to make sure they have that excess capacity and make sure that events like these can go through without any other impact on their day-to-day operations.
Right, Luis, I want to jump in and say, for the past 10 years or so, there used to be the phrase, when the VIX is 25, time to buy. I think VIX has been hovering around that for some time, so it's definitely a new normal we're getting used to, especially since it went up into the 80s for sure.
Yeah, so now when the VIX gets 20, we have to buy more hardware.
Yeah.
So the next question, as data and data sources increase, there's more tools, more computing power is being required to make real-time decisions. So how are you guys dealing with this? So I'd like to start with Dan this time.
Sure. So I think a lot of this is, for us, efficiency has always been a large part of what we try and do with our technology. We try and squeeze the maximum value that we can out of every CPU cycle that we're working with. Next to that, the technology shift, cloud's not a new phenomenon, but shifting data and analytics platforms, and particularly streaming market data into cloud ecosystems, continues to present some challenges. For us, balancing the real-time nature of our systems and the history, there's certain things that you can do with hybrid architectures, and that's somewhere that we're having a lot of focus. So you can keep, real-time components co-located at the exchange, if you like, or within your own data centers. But you have the option to move historic layers out to cloud providers, take advantage of cheaper storage solutions, that kind of thing, but still present a holistic platform. So it's these days, cloud has really changed the hardware roadmap for our clients and how they view technology. So that's again a big focus for us. There are lots of sort of well-documented challenges with it, not just technology based, but security as well. There are still infosec concerns around and controls required around content, especially where trading and transaction data is concerned. So that all of those dynamics still create some challenges. So hybrid is a big area of focus for us in ensuring that we can support people in the cloud as well as on premise. Next to that, the big data providers, and I'm sure Natalie will talk about some of this in a minute, and the exchanges as well, starting to make their data and their content available, solving some of the challenges around data distribution and I think Ronan was talking about determinism earlier. I'm not sure he was talking about network latency in the cloud there, but I'll go with it. And that's one of the key things. But also things like multicast support. All of those challenges still remain even today in the cloud. So, but being able to take advantage of some of the features of the cloud providers and their scale up performance, that is a big part. So that we can minimize the excess capacity that you were talking about, Luis, and ensure that we're being as efficient as we can. Beyond that, there's some very interesting things happening now around Optane and persistent memory that also fundamentally changing the way that we look at computing at the machine level. The line between traditional storage and RAM is increasingly blurring. And that gives us lots of options around the way that we make best use of memory and storage capacity. So there's a few sort of big disruptive players mostly on the hardware side, actually, that are having a big impact on the software and the way that we structure. So that really allows us to do new things and minimize our wastage while still keeping the good performance that we've all seen and the ability to deal with this kind of volatility.
So I can jump in, Luis, if okay. So how we deal with the ever increasing amount of data and data sources. Dan, you mentioned, haha, as a big data vendor, we love being a big data vendor, and I get the pleasure of working with our innovation team, which is not necessarily just a data science team. We have UI experts, researchers, full stack engineering teams, full stack engineers on there. And the way we deal with the large influx and explosion of data, and it really has exploded. The amount of data that will be provided in the market between now and 2025 I think it'll increase maybe 4 times over. We've seen an increase in the number of data science roles that are needed by not just us, but our customers. I think in the last 5 years, data science roles have increased 400%, something like that. And they are gaining more traction in our customers. And why is that? Because they're needed on the innovation side. They're needed to write algorithms. They're needed to write project development. And our team collaborates to precisely do that. Our innovation team works on products, and we're constantly looking at new ways to display and distribute, I guess related to trading, it would be analytics upon the data that we have and pushing that out to the market. That's solely for the purpose of improving, say, a trader's experience, because many of our members of our team did work for our customers at some point, so they know the precise pain points. We're dealing with it in that way. Additionally, at Refinitiv, we're finding that as a company, and also, personally, when I speak to customers, speak to say industry colleagues, esteemed colleagues, they don't want to drink from the fire hose so much anymore like they used to. It's not just give us everything. What they really want is precisely data for their needs, and then having a manageable way to ingest and organize that data. So data management is something that we focus on quite deeply because that's needed to push projects forward, not just for us, but for and within our customers too. So we focus on that. It's data scientists, the role of analytics, and data management and organization.
Okay, great. Thank you. Rana, do you have any take on this?
Yeah, I'd say from an exchange, I think where I differ here is we're more of the consumer of data. Yes, we generate data, but from the consumption of data, it's difficult because we're running a stock exchange in a tightly regulated business. And like we all said, everything fared well in March. But I kind of equate it to like when you try to repair a highway while people are driving over it, it's much more difficult than just building a new stretch of highway. So upgrading and keeping up with this is relatively difficult. So we're doing some things like our entire LAN has been 10 gig since we launched in 2013. We're going to 40 gig, right? Because And Dan knows determinism on the cloud. We can talk about that in a few questions, but determinism within our platform is like if a client gets an acknowledgement time and it's different than their previous one several microseconds before, they come back and they nicely kick our ass. So we're constantly upgrading things along that line. We just went to kernel bypass, which is an old technology, but that's helped us. So I think COVID aside, exchanges have to constantly do that, and we continue to do that. Hardware refresh, again, every time we do a hardware refresh, by the time we implement it in and roll it out, it's already close to obsolete. It's really frustrating, but it's a constant effort. It's a constant effort.
Yeah. Yes. Well, that's part of the job of all the exchanges. And I think all of us here, we have to be working on that every day, make sure that we have the latest and greatest to make sure we can do that. So talking about that, Ronan. So latency in trading and high frequency trading have been a constant in all trading technologies.
Yep.
For those in the audience who don't know or who haven't read, they should go and read the book Flash Boys, and understand a little bit more how it works, especially in other markets in the U.S. If they're from Mexico. Mexico has only two exchanges and about 30 members, so the structure is different and the problems are different. But I think the way things happen and the way it's going to be globally pursued is going to be pretty much based on what's happening in the U.S. So what is your current take on this?
Yeah, no, it's a funny one, because I can probably go back 15 years ago where people would say latency is at the extreme now. You can't eke any more out. And I will tell you, anyone who says that doesn't know what they're talking about, because it continues to be the case. So future trends and latency, what I will just tell you now, factually, this date in 2020, there are tons of strategies that sole determinant of success is being the fastest. Absolutely, unequivocally. When we running an exchange like you guys, our members are broker dealers and high frequency trading firms. And it's pretty remarkable when you sit as an exchange and not as an individual broker. And we have to keep this information, private, but we can literally see who responds to what and how quickly they do. And then we can see when someone makes a change and the difference that it makes. And I'll give you an example. One that always blows my mind is when a new bid or offer is set. So the bid in the market is 10 and all of a sudden it's 11. How quickly do people join the inside at 11? Because being top of the queue is obviously a massive advantage. And you'll see, which I know it might not blow people's minds, but if you think about how quickly they have to react and get the order on the exchange, we'll see in 43 microseconds, a whole group of people join. About 120 microseconds after that is the maybe the quant firms, not the super high frequency. And then literally 5, 10 milliseconds, seconds later, in come all the brokers representing as agencies. It kind of cracks me up. So what I would say is that's not necessarily acceptable anymore. And brokers are looking for ways that they can not necessarily set the inside, but compete from a low latency standpoint and join the queue. And we can talk about it when we talk about, AI and machine learning. But we as an exchange built a machine learning model that we just got approval for a few weeks ago, something called D-Limit. We've been running it in non-displayed, but we're doing it for displayed out loud trading right now. And this is allowing brokers to do things they could not yet do before, because the speed at which they would have to compete just doesn't make sense. When you're regulated like an exchange or you're regulated like a broker, you cannot join the arms race. Even the high frequency firms can't join the arms race. And you'll see in the US and probably globally, there's been a huge consolidation of high frequency firms buying other firms, because the economies of scale and the cost of doing this is it's so prohibitive. You're not going to see the four guys in a garage in Brooklyn start a new high frequency firm ever again. That's gone. That hasn't happened in the last 10 years. And I'm not sure it's the full direct answer to your question, but some of the other trends that we're seeing, there's remarkable things going on. A firm was telling me recently, the analogy he used was like Goldilocks, right? So they have to do a Java virtual machine port warming. And basically what it is they need to keep their ports active, because if the port is inactive or too active, it has an impact to their latency. So it's kind of like the porridge is cold, the porridge is hot, the porridge is just right. So then some people are literally, to keep their ports active, are trading with test symbols just to keep fake trades going through the system to keep them at a certain level of rev, which now, from what I understand, the regulators are not looking kindly on. But just if you really look at it, there's it's not just cutting down the length of your circuit anymore. There's much more intricate ways to compete in the latency game, but it's just become much more complicated. As you can probably tell, I kind of really love this shit. It's funny.
Yeah, we all do. Yeah, but it used to be that the slowest link in the chain would be the network.
Yes,
right?
yes.
So that's why everybody's focused on the network.
Yeah.
Now it's really, we're getting not there anymore. All the computing power is and all the things you do in the computers probably makes it slower than the current some of the networks.
Yep.
And that's what's causing a lot of pressure on software developers and architects and you name it, and probably quants or whomever, to make sure that those trades or decisions are made faster to get to the network, to get to the exchange and fill in that trade. So just for those in the audience, Ron was talking about microseconds, and to get a feeling of that, the blink of an eye is about 300 or 400 milliseconds. That's 1,000 times more than what he was talking about. So those times are really, really, really short, and exchanges and high frequency traders need to make sure that they get their information as quick as possible, make the decisions and react on it, and get it to the exchange to get filled up on those time slots. Great. So now talking about artificial intelligence and machine learning, that had been getting a lot of visibility in the last years. It's maturing as a technology. So how is this changing within the financial markets? So Natalie, you want to talk about that?
Sure. I love talking about this. We know what Ronan likes to talk about. I love talking about AI and machine learning. It's phenomenal. I'm very, very pleased to see sort of the explosion of adoption of AI and machine learning these days. As many of us know, AI is not a new concept. It started in 1956, and the reason that AI machine learning is really able to make compelling gains nowadays is because we have the confluence of two things that we didn't have in conjunction before. It's big data, and then it's the computing power to process that data. Before we had some computers that could work well, and then maybe we had some data, but now that we have both at the same time, the rise of artificial intelligence is something that no one can deny, and many of our customers, we ourselves, are investing in this to make sure that the experience is better, and basically to automate things, make things easier. And Refinitiv is releasing our annual AI machine learning survey that comes out quite soon, I believe shortly. So if anyone is interested in that, we've interviewed everyone all up and down the AI machine learning value chain to see what are the problems and with workflow of data scientists all the way up to C-suite. But in relation to your question, Luis, what I want to bring to the top of people's minds is the concept of edge computing, which I think is going to be quite big. And as we well know, edge computing sort of comes off the back of cloud computing. Traditional cloud computing involves processing data in storage facilities, more decentralized location. If you think of that centralized location, offshoots, sort of like bicycle spokes, you have these end devices. Call them Internet of Things, autonomous cars, and whatnot. Edge computing is sort of this computational framework that brings sort of data computing and storage where it's needed on the edge near those devices, so that response time and latency can be lowered because AI and machine learning is responding on the edge instead of having to send a signal all the way back up to the cloud and down again. And the way it can be conceptualized is think of autonomous cars. there are sensors on autonomous cars to make sure that you don't injure anyone on the road. If the sensor needs to send a signal that someone's in the road all the way up to the cloud and back, it might be too late because we're talking about very short amounts of time that need to be responded to. The centralized cloud is actually too slow for that. So edge computing mechanisms can be implemented in the car itself to make sure it stops, the brake stops before it hits someone. And AI and machine learning is now actually becoming more mature, which I like very much. And as Ronan was speaking, he was talking about the intricate ways in which we can address latency and security. And edge computing is one of those ways. It's a bit newer, but gaining momentum, in which, if we're dealing with traders specifically, you can help keep their functions secure, keep everything in line and up to compliance standards as well, if you use this new technology. And a new study came out that said about 30% of respondents were going to invest in edge computing, mainly because it was so secure. We're seeing a lot of customizable customer experiences through edge computing as well. And this is all in addition to the broad scale automation that we're seeing, which I'm sure I don't need to go into, and I'm sure Ronan and Dan could go into it in a lot more depth than I will, how they're automating systems within trading as well.
Yeah, and I think just to echo some of those statements, the maturity you mentioned there, Natalie, is something that we're seeing continually, at clients. This move to ML ops and ensuring that the models that are being developed are thoroughly tested and that they're well managed. Ronan was mentioning, getting regulatory approval for their new machine learning model and having that level of oversight. ML's gone through a maturity curve. In the early days when we were seeing it, it could be a bit Wild West when, without the right regulations, testing, models were being produced quickly and people were still trying to work out how to manage their software ecosystems to ensure that these things were well managed. But I think that's coming under a lot more control now. And again, the edge compute is very interesting for us as well. We do a lot of work in automotive and IoT. This is a finance panel, so I won't go on it too much. But part of what we do, again, that efficiency thing, which is always our kind of core sort of value proposition. The heart of our technology is only a 500 kilobyte install. So that means we can bring the whole power of our analytics solution right down to the edge. But it'd be one of the key things in actually producing things you can run at the edge is ensuring that you can train the models well. So, Natalie's entirely correct. You wouldn't ever want to have something like an automated car have to talk to the cloud before it can do something. That's not going to go very well. But equally, the volumes of data that are produced, by those vehicles, can't be analyzed on the car. And actually, to train intelligent models well, they need a lot of data. So that's where offload to centralized systems for training, is the confluence of those two technologies. So yeah, it's really moved into the point of being real now, and it's not something that everybody was trying to work out. It's very much matured in the finance space, and again, where we're working across verticals. For my background was always in finance. It's been very interesting for me personally to see actually just how far ahead of a lot of other verticals that the finance arena really is. As Rona was saying, and Luis as well. Trying to stay ahead, all the time. You've got to be changing the wheels on that highway all the time. You can't stand still, because if you do, you're going backwards. So, yeah.
Yeah. So Ronan was saying about machine learning and exchange. I would guess that's a use case of machine learning at the edge, where the edge is the exchange, and that's where the decisions have to be made. So
yeah, you took the words right out of my mouth. I was going to go, Natalie, I love to talk about a lot of things, but your analogy was great, because I literally scribble on the page. The exchange is the edge, right? Because like a lot of times I thought, to Dan's point, and I'll say it nicely, that a lot of machine learning and AI was a bunch of fluff. And now it's something that's real and it's deployed. And basically not an IEX pitch, but what we've done is we've gotten approval for the first time to use machine learning as an exchange in the US. I'm not sure if anyone's doing it globally, but we built a model whereby we predict which way the quote is going. We predict if the quote's going to go up and down. It's an option. It's not on every trade. And what we'll do is, because we're at the edge, because we can react to it faster than anyone, even the high frequency firms, because IEX has a speed bump around us, we have a 350 microseconds, which is funny you bring that up, Luis. It's 1/1000th the blink of an eye. It's funny to call that a speed advantage, but in this day and age, that's a massive speed advantage. We might as well have a 3-minute advantage. But what that allows us to do is we run our machine learning models, and before they were machine learning, we sort of had these static models that showed, like, if the bids started to disappear off exchanges, your eyeballs would tell you, well, I know the price is going to go down. You know, as the offer fills in, you know the price is going to go down. All we've done now is our machine learning predicts which way the market is going and learns from that. So if the prediction and the static if-then statements that we programmed are inaccurate, it actually automatically fixes, and the new if-then statements become what the machine derived. Like Dan says, you definitely got to keep an eye on it. You don't want this thing to go machine gunning off and predicting incredibly inaccurate. But what's been amazing is we actually now got approval. So if the market is 10 by 11 and we think it's going to 9.99, the SEC has given us approval to move that quote to 9.99. And we've more than, in the first 11 days of this, doubled, almost tripled our lit market share, because the industry is looking for things like this. The brokers can't compete. The market makers can't compete with the fastest of the fastest. So to both Dan and Natalie's point, like this is really where it's going. And I know it's used in a bunch of other verticals, but obviously I'm laser locked with blinders on my own. And I just think it's pretty amazing to see stuff that I kind of thought was fluff for a number of years actually working. So you can probably tell I'm pretty excited about this one too.
Well, yeah, thank you. So financial markets in general are early adopters of technologies. And we see a lot of convergence or shares of technologies between things like the telecom industry or car racing, as Dan can talk us into, and make sure that all these technologies that other industries are using for their specific niche are then later used in financial markets, or early adopters before it's really rolled out to the public. So Dan, do you want to talk a little bit about how you see that in your industry? And I know you're a car racing fan, and you have some cars racing around, and how you're merging those technologies between what you do today and what you see out.
So, in terms of financial markets being early adopters, just, I kind of, not to repeat myself, but, I do think the financial markets are always on the edge of, not the physical edge, on the technology edge, and pushing that envelope all the time. I don't think there's many other industries where we'd be having a conversation that the 350 microseconds is might as well be 3 minutes, right? that conversation only happens in financial markets. And is that going to change or stop? Absolutely not. The whole time that people can find alpha in technology, they're going to be going after it, right? And that's not going to change. In fact, it probably keeps accelerating, and that's one of the challenges, is just keeping up, with all of the new innovation that's out there. There's a lot going on. So the parallels for us are now interesting. The racing and the stuff that we're doing in Formula One has particularly, actually, Natalie, it'd be good to catch up on some of that. It's been really interesting to see the way that the F1 teams and the kind of problems that we solve in those spaces. The shape of the problem from a data perspective is very similar. On exchanges, it's a time and an instrument and a price and a size and a few other bits and pieces. from a car, it's a time and a sensor ID and some values that tell you what's going on with the sensor, So the kind of shape of the problems are very similar. But it was interesting to see what they were doing with machine learning. Looking at things, sensor failings, and trying to work out when they were getting accurate readings from sensors, and also driving us, into new spaces and building frameworks for things, that we call conditional analytics, where, you're actually going to trigger behaviors based off a certain number of analytics or calculations or values that you're seeing interacting together. So in the Formula One space, that was, they were looking at things like, what is the engine temperature when the engine rev limit's been running, above this value for this period. And then, triggering alerts and things off the back of that. The parallels there that we've been driving back into finance are in things like surveillance. So, when you're seeing, particular behaviors or things being held on the book or prices being further away, triggering further investigation and analysis, and that allows us to do a much deeper inspection. You're not just looking at a single data point, deviating from a historical normal. You're doing much more in-depth analysis. And they also pushed us very hard at, when we started with them a few years ago, on what's now becoming ML ops. And, there's lots of things you have to do around different versions of different libraries, lots of boring tech stuff to make sure that, when they're building and training, that you've got all of the right libraries to actually run that in production. So all sorts of complexities under there. So, finance is, when we started, I would said, actually, particularly even, so some really, it's an interesting panelist, because you've actually got almost the whole ecosystem. You've got Ronan and the exchange, and they have, big challenges in processing volume. Natalie and the data vendors have to do an incredible job of staying ahead of that volume play, because, if they break their distribution, well, the exchanges can't talk to the world, and vice versa. And for our part, if we can't receive it and ingest it and actually deal with it, then you get this cumulative effect of breakdowns. And across networking and data distribution and management and execution, I would say that finance in many ways is 10 to 15 years ahead of what we're seeing in other industries in the data space and the maturity space. But they're catching up. So
well, they're catching up, but then we're moving forward, so they're never going to be able to catch up. So let's talk a little bit about cloud. Cloud has seen a lot of traction, and given that there's it's not a solution that fits all. Everybody think that cloud is one thing that or you use or you don't use for everything. And I think it depends on what you're going to be putting in the cloud, what are you going to be processing in the cloud, how do you want to put your excess capacity in the cloud or not. So in the financial markets, how do you see that fitting? And we can divide it in the different layers. So why don't we start on the exchange layer with Rona, and also talk about you were talking about the determinism and latency around that. So how do you see that on your side?
So I don't want to represent that I'm a cloud expert by any means. We do use the cloud obviously here at IEX. We have a couple of side businesses. We actually have a business called IEX Cloud. But what I would say is on the positive sides first, as it relates to finance, there used to be the perception of the cloud not being secure. And we've been able to get by that. So now you'll see financial companies, both buy side, sell side, no problem storing stuff in the cloud. Another positive one, I was talking earlier on about New Jersey trying to impose a tax. It'd be kind of interesting if all the exchanges could run in the cloud, because then unless there's a cloud tax, I guess we could kind of move anywhere. But the negative part to it, and Dan touched upon this as well, is a huge amount of communication, especially in U.S. equities, again, is the vertical I focus on. So I don't want to say it's everything, but the multicast nature of how we distribute data and doing that over the cloud is very, 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 very problematic. And we've been doing some testing on that, and it's actually going better than one would expect. But it's it's nowhere near where it needs to be right now. And then the determinism of the latency. It's just stating the obvious. You're at the edge of the cloud. You're still getting nailed with latency, and like I was saying earlier on, like the single-digit microseconds were held accountable for if the act times, are non-determinist. You'd have milliseconds minimally on the cloud. So it's something that I think there was a new exchange that just launched, so like in the US called the Long-Term Stock Exchange, and they had tried potentially to build it in the cloud. But even from a regulatory standpoint, just to bring that into play, they weren't comfortable with a cloud deployment either. So just from my perspective as an exchange, we're there with security, but everything else, no.
Yeah. Thank you. What about you, Natalie, on your side? Do you see that shifting to the cloud on your side or not?
Yeah, we see, we pride ourselves on being cloud agnostic on the innovation side here. Within our projects, most of them have a cloud element to them for scalability, honestly. So whether it's a public cloud provider or other types of cloud environments, we use them quite a bit in our projects. What we see within our customers is there was the beginning phase of introduction of cloud technology. People were getting used to it. They were getting used to thinking about it as being secure, maybe even more secure than, say, a locked data center, which we know now it is. And now we're seeing, to touch on Daniel's point, hybrid. We're seeing a large amount of interest in hybrid cloud and cloud aggregators. That means taking someone's home data lake to their home cloud environment to a public cloud, and bringing it all together so that I work in the world of just data science. I've mentioned that quite a bit, but so that data scientists and say it's even traders, say it's a team within the customer, they need to be able to access the data lake, the home cloud environment, data from Refinitiv, all in, say, an AWS or a Google Cloud platform. So these data aggregators are facilitating the ease of the workflow because they're able to put all of that data and make it easily accessible. So that's where I see cloud getting a lot of traction here, and I'm excited to see where it goes with these cloud aggregators. I know cloud has exploded in its popularity. But there are a few major players, and we work with all of them.
Yeah. And what about you, Dan? Do you see that probably the percentage of things done in the cloud versus on-premise and the hybrid approach being shifted to a different percentage?
Well, I think using cloud is all about finding the right use cases to move there at the moment. I am not brave enough, and I won't say that they'll never be ready to deal with high frequency trading because somebody will prove me wrong next week. So I'm not going to say that, but where we are right now, clouds are very, very good at scale up compute. But by their very nature, they put a software layer between you and the underlying hardware. Earlier, I don't know if anybody picked up on it, Ronan mentioned they'd implemented kernel bypass as part of their recent work. And he said that's an old approach. Well, it kind of is, but what you're doing for people that don't know, kernel bypass means basically bypassing the operating system to an extent, simplifying the OS and going straight to the hardware, right? But if you imagine you're putting a hypervisor and a virtualization layer on top of the OS, on top of multiple machines to give you that scale up compute, you certainly, it's very difficult to do things like that in that kind of environment. So going after the sharp end of high performance computing and high frequency trading in financial markets is probably the hardest thing you could ask cloud providers to do. But that doesn't mean they don't have their place in the financial markets. They absolutely do, because there's many use cases where they are fast enough. And again, time is relative, right? Not to get too philosophical, but fast, to an exchange or to a high frequency trader is measured in, single and double digit microseconds. But, if you are doing surveillance, as an example, on, whether that's a broker dealer doing it on their own, executions, or whether it's an exchange doing that, you don't need the same level of performance. If it's post-trade reporting or analytics or regulatory reporting, they're all good use cases that require, lots of compute, lots of data, but don't necessarily need that highly deterministic behavior, nor, the very low latency or the lowest latency that we see at the sharp end of HFT trading. So, and when you look at broker dealers and sell side firms, it's things like HFT that always get the headlines. It's like the front man in a band, right? But that's the sexy bit at the front. But you've got a whole group behind it that have to do a whole bunch of other things, as well. I'm stretching this a little bit to make decent music. I'm not sure where I'm going with that. Anyway, so it's all about finding the right use cases to move up there. Running your own data centers and all that kind of thing is not just expensive. It's hard work and requires lots of people and lots of investment in time. Has effect on balance sheets and all that kind of stuff. So anything that people can move to a service in the cloud, that makes sense. It's just about picking the right things to move up there. And hybrid really comes into it, where you want to do a bit of both. If you want to run analytics at the edge in a colo facility, you can do that. And if you want to run your history and slower pieces of it, up in the cloud with an interconnect, you can support that kind of topology as well.
Yeah. Plus also all the expertise you need in all the technology stack, right? Doing kernel bypassing. I don't think cloud providers will ever do that.
Well, yeah, but those guys, they continue to innovate extremely quickly. There's new approaches coming from them all the time, new services. So, they'll keep bringing new tools, I think.
Yeah. Thank you. So financial markets have these waves of globalization, right? We see probably in the past, probably in the dot-com boom, things coming all globalized, and we kind of shrink a little bit. So do you see new trends for markets being more interconnected? Do you see more exchange consolidations, Ronan?
Yeah, so it's actually been interesting because it's not exchange consolidation, but even as recent as last Friday, CBOE markets purchased BIDS, and BIDS is like the largest block provider in the U.S. right now. So it's one of those blotter scraping type solutions. LiquidNet was just bought a few weeks prior to that, and then MatchNow, the largest Canadian dark pool, was bought also by CBOE a few months ago. So there's actually been quite a bit of that during COVID. And I'm not sure if that's an advanced read on regulation, because the way that works right now is those venues look like dark pools. So they have to be run completely individual, separate to one another. But if you look at a lot of the consolidation that people will call it in U.S. equities, right now, just as of recently, just 3 new stock exchanges launched in the past month. But prior to that, there was 13 exchanges. And only one IEX was individually owned. So you have New York Stock Exchange owned 5 exchanges, CBOE owned 4, NASDAQ owned 3. Generally, in industries, when people acquire people, they sort of gobble them up. And in the exchange landscape, all those acquisitions that have happened, like in the past couple of years, like like Chicago National Exchange, no exchange ever gets closed down. So they remain fragmented. So consolidation is an interesting one because it's consolidation of ownership, but definitely not consolidation of the number of platforms. And the same thing is happening now with like BIDS and LiquidNet and MatchNow, because you're not, from a regulatory standpoint, allowed to consolidate them in any way, size, shape, or form. So it's kind of interesting. I mean, if someone wants to consolidate and take out IEX for several $1 billion, I listened to that call, but no one's made that call just yet, so we'll see. It's hard to decide. But what has been strange is a lot of that those changes, they've all happened during COVID. So like in times of uncertainty, it's funny that so much is going on.
So you think COVID has put pressure on the markets to do that?
Yeah, like I think COVID and also the new entrants to the market. So if you look at the new stock exchanges, particularly 2 of the 3 are consortium-owned venues with very, very fast technology. And a lot of people will say it reminds the industry of BATS 10 years ago when BATS launched, owned by a bunch of brokers, many of the brokers that own Memex. And I think what you'll see in the US is you're going to see a venue like Memex, the Members Exchange. 2 of the main owners are Virtu and Citadel. And they are on one side of 40% of all volume in US equities. 40, not 14. It's massive. So to think venues like that with a lot of principal flow can't garner market share very quickly is a crazy thought. And venues like CBOE, if you think why are they out gobbling up other opportunities? Again, this is just my opinion, but I think I'm right, is that the one thing Memex can't compete in or MIAX can't compete in is the primary market of opening and closing stocks. And the auctions are still a big part of overall market share. CBOE doesn't have any of that. They have a minor amount of that in ETFs. So I think COVID uncertainty, new venue uncertainty is causing people to scramble and do things different and innovate differently. But I don't know that you'll see exchange consolidation because other than the 3 new exchanges, the only exchange that's its own family of one is IEX. And I can tell you as of this date, we're still trucking away with no plans to go public and looking to do our own thing. And when I thought machine learning was cool, Dan just upended me with the Formula One stuff. I love that. That's sexy. More sexy than the front man of a band.
Yeah. So talking about another trend in technology, blockchain and distributed ledger, that has been getting also a lot of traction, or at least a lot of buzz around it in the markets. So how do you see that becoming in a couple of years? Let's start with you, Natalie.
Sure. Blockchain. Blockchain has been around for a little bit now. It had a it rose to the top of the hype cycle like the VIX in March. It was real up there for some time. Then it kind of peaked and went down. And then the market, who got very excited, took a step back and said, let's take a look at practical use cases for blockchain. And to use a phrase from Ronan, when you see something of fluff start to get, grow legs and get meat on the bones and whatnot, blockchain is very much trying to get meat on the bones there. And I'll tell you how and where. It's inevitably tied to cryptocurrency, which a lot of banks are talking about, a lot of individuals are talking about with digital wallets. But in trading specifically and with banking, distributed ledger technology probably has the broadest applicability with transferring large sums of money to organizations cross-border. A study came out about, I'd say 2/3 of banks are trying to investigate just how that can happen, how they can explore blockchain or distributed ledger technology. And the reason for that is that processing every one of these bank payments, say, I worked in Asia for many years. So if you have a company inside China and then outside China, you're brokering a deal and then the payment needs to be made, it's very difficult. In the US, you use SWIFT codes. They're looking for alternatives for those processing payments, which is where distributed ledger technology could facilitate that quite a bit. It's faster than the SWIFT codes and the traditional payment network. And also it's very secure. So I won't go into how blockchain works, but it does create a structure on the ledger that is very hard to forge. And it's an alternative to the traditional payment network. So when we're talking about creating comprehensive and reliable data records, that's where banks can really benefit from this. And and with the knowledge of that, with all of our knowledge around knowing that the ledger is it's very hard to hack, very hard to alter, and the blockchain keeps moving on. People are mining, and creating new nodes in the blockchain. That creates a very good and buffer, I guess, isolated sense of security. So that's something that that distributed ledger technology can bring to banking. And I see it's probably like the most plausible area where there could be gains. The drawback is the currency within which we make those transactions, right? Are we going to make them in Ether? Are we going to make them in Bitcoin? Are we going to create a US dollar? I know China is working very heavily on a digital currency that is taken quite seriously amongst its population and for banks as well. So it takes a little bit of a leap of faith that I don't see the banking industry there quite yet, with wanting to take a major transaction or a deal, merger, or acquisition and make that completely in Bitcoin. I don't see that just yet. But blockchain and distributed ledger technology is making gains. There is investment in it. But I would say now people have cooled off a little bit in an appropriate way, where the emotions and passion for it is not running so hot as it did in the beginning.
Yeah. Do the rest of the team, do you guys see any other use cases where that would bring some value to the markets?
Yeah, so we got involved in, to use a word that Natalie used of my word, fluff again. But I do agree. There was a huge fanfare to it. But we did something interesting where we started a joint venture with a company called Tradewin Markets. And what they do now is they have a platform. IX built the technology for them. But essentially in the US, right, ETF GLD is the biggest and most expensive way to trade gold. But ETFs have fees, annual fees. So we talked to a lot of institutional investors, and there's a point to my story in a second, but they want to own physical gold, but don't necessarily want to pay the fees. So we partnered up with Tradewin Markets. Everything is settled on the digital ledger, a distributed ledger, and we store physical gold in the Royal Canadian Mint and deliver physical gold, but everything is traded over the ledger. The problem there is that when push came to shove, while it's cheaper to do and the ledger is cool to do, most of the institutional investors don't have mandates that allow them to trade in this sort of way. And per the 40 Act with the SEC, these are not deemed necessarily securities. Now, a lot of the blockchain and the distributed ledger companies are trying to get securitized so that it's a recognized asset. But we built something that we think is really cool, and it actually works, and it's an applicable way to use it, but we don't trade much as a result. So not a great story.
No, I think it is.
Yeah.
I remember you quoting yourself, Ronan.
Yeah. I quoted you quoting me.
I think we all know how that dotted line worked.
Yeah, so that's a regulation issue, right? At the end, it's not a technology issue, not the use case. It's we'll have to wait until regulators catch up on that. And I have a question on regulation and a couple of questions more. So see if we can get to that. So the next one is about cybersecurity. Cybersecurity is an everyday issue now, it should be for everybody. So how is it changing the way we think of our products or services? Anyone?
Who wants to go first?
Well, so I guess we see this in a lot of different dimensions in different verticals. For us as a software company, it's really about making sure that everything that we produce can be secured. Not everything that we do, certainly in the early days of KX, which is in technology terms a very long time ago now, but generally it was, the systems that we were building and deploying were inside, a locked data center with armed guards and all of the rest of it. So we didn't have to worry about security too much because the rest of the infrastructure around us was taking care of it. Particularly with cloud hybrid deployments, again, those boundaries are not quite as fixed as they were. So for us, a big focus of this is really just making, on the one side of it, making sure that our software is as secure as it can be. But also then looking at the architectures, again, of things like the cloud providers to make sure that when we've got infrastructure running up there, that we're using the right services and that we can integrate with the right things to ensure that those environments are secure. The other side of it for us is actually the other end of it, because we do a lot of work in the cyber processing space as well, PCAP network capture, and then the kind of the data analysis on top. Those guys are all very secret squirrel, so I wouldn't pretend to know the details of what they do underneath that, but that's kind of the other side of the use case for us. So it's really just making sure that, and in fact, it goes in a number of different ways for us as well as a business. It's not just making sure that tech is secure, it's also making sure we've got all of the right certifications to do the kinds of work that we want to do. Because, where we are providing managed services to clients and all of that, we have to have the right levels of security, that the banks would have inside our own offices and institutions as well. So there's kind of lots of regulation that comes in when we're trying to do things like that.
Yeah, I'll just sidetrack a little bit. Do you have any thoughts or insights of how the Formula One deals with cybersecurity? I mean, the cars are going to be more software based than they used to be in the past. So I suppose cybersecurity is going to be, or is, an issue today. So do you have or know anything about that?
Well, so the Formula One teams are very good at using things like media and legal restrictions, firstly, to make sure that you have to be very careful with what you do and say, because it's a very public space. They internally, I suppose, nothing to do with us or the security, but there's very well publicized incidents where I think it was somebody that was moving from, I'm going to get this wrong, so I'm not going to use the team names. He was moving in between teams, and he literally photocopied the car things, and that ended up costing that team hundreds of millions. It was very public, very embarrassing. So there's kind of that side of it. But then internally, they have, again, many of the kind of common things that you would expect of a financial institution. So they do run their own data centers, actually at the manufacturing facilities. One of the big teams that we work with, they operate out of two separate geographic locations in Europe, so that they can support hot and independent resiliency. And this is just a single team. And they actually have a hybrid deployment on Azure as well. So it kind of what's interesting about them is also then that they run trackside as well. So you have to be able to secure what you're running at the track, and comms back. And the thing is, the track moves. It's not the same place all the time, right? So we get to do fun stuff like deploy the software on trucks, and then that drives around to different circuits, and then the infrastructure teams have got to deal with securing that stuff. So there is a lot of kind of commonality in between it, but it's really very similar to problems and challenges and solutions that we see, when in the financial space as well.
Yeah, that's what I'm seeing. At the end, we all have to protect the services or software, and we have all the same kind of problems and tools that we all have.
Yeah.
So on the going back to the regulatory environment, what do you guys think about how the regulators are coping with all these technology changes, and are they coping or moving fast enough for the markets, or do you think that they're just waiting to see if one of the technologies just phase down and then don't worry about that and just wait for the next one? Or what do you guys think about that? Rana, you want to start with that?
Yeah, so I'm actually, not just because they're my regulators, but I'm actually pretty defensive of the regulators, because a lot of times people would say, they're trying to police people on bikes. Well, the the people they're policing are driving Porsches. And what I'll say is over the past, call it 8 years, the SEC in particular has become far more progressive. And the people in which they have there are industry practitioners like quantitative trading, people from the brokers like Brett Redfern, who runs trading and markets right now. He's probably near the end of his term because it coincides with political elections. But he came from the broker-dealer side. And the reason why I think that's interesting is most every head of trading and markets prior to that, not that there's anything wrong with them, but was a lawyer. And I think you really need people who've been in the trenches and are actually talking about microseconds and why they matter to trades and what a pickoff is. And I just think it's really impressive. And they continue to hire more and more people of that ilk. So I've been pretty impressed with how they handle technology. They've done some interesting stuff and how they take in data. I think even just like the approval process, just to get our machine learning model out there, their approval order was a 52-page document. So it's like it's pretty complex. And I think the more complex the markets get, it's unrealistic to think that the regulators won't grow with them. So I've actually been really impressed, because if you read some of my public comments from maybe 2012, I wasn't impressed with the previous regime and said so publicly. But now I am. I think Luis is frozen, so I'm going to hand to you, Natalie.
Yeah.
I'm the new moderator, guys. You guys are in trouble.
Thank you. I do know that we have some. I see Luis is back, but we have some left. Luis, I don't know if we were accepting questions from the audience. I'm more than happy to speak more. I do want to say though that. I think we did cover all the bases, and BIVA did an excellent job with getting 3 different areas of the industry here to have a meaningful conversation. I've enjoyed it immensely.
Yeah, great. Thank you all for joining. I'll get a question from the audience, probably just a couple of minutes before we start wrapping down. So the question is, with so much technology and its constant evolution, human interaction is less and less. You think that in the medium term, technology will replace a human in the financial environment?
Interesting question. I don't think so. I think generally technology allows us to do more. But we talked a little bit, and Natalie is definitely the expert here on this, so I'll defer to her on it. But even the machine learnings, the AI models, they still need oversight. They still need, a big area where we're seeing them used is actually the distillation of signals. So actually reducing, or particularly around, I'm trying to think of a good use case to give you an example. So like surveillance, in the past, you'd have a system throwing out a huge number of potential alerts that require, somebody to go and investigate and turn out to be nothing. Well, now we can use machine learning to actually reduce that set, prioritize it, and give the human operators, a cleaner view of things that they actually need to go and look at. So, I think it definitely changes the dynamic, but I don't see it removing people completely from the arena. It just allows us to do more.
I think it's actually a great question, and I agree with Dan as well. It's changed roles. So there's a lot of roles that have gone away. So like the traditional cash traders versus electronic traders. When I was on the trading floor 10 years ago, it was probably 70% cash, 30% electronic. That's inverted or more now. But like, even if I look down, we're 92 people directly tied to the exchange here. We have like InfoSec, compliance, data scientists. Data scientists, what the hell is that? We have quant researchers, business analytics. There's all these other types of roles that exist. And there might be more roles now, actually. It's just different types of roles. So the computer science is like, I keep trying to tell my kids, but if they take after me, they might not do it. But I'm like, do computer science, because there's so much requirement, that and InfoSec. But yeah, there's less people in certain roles, more people in many more roles.
Right. I think you both covered it. It looks scary, honestly, when we think of AI and machine learning sort of automating all of these many varied things. When you go to the floor of the New York Stock Exchange, there used to be packed with people. Now there might be 30 that work on the floor, having it all digitized, and that's scary. But the goal of all this increased technology and automation is not to build a second human brain. It's to actually assist in automation, making processes faster so that we can expend our efforts on other things within the industry.
Yeah, and I think I agree with all of you. And Ronald was saying that his machine learning component is there and is doing all the work, but they have humans just making sure it does not do anything that it's not supposed to do. So at the end, humans doing that interaction, making sure everything is working good. Okay, I think time is on top of us. So I'd like to thank our panelists, Natalie, also for catching the ball when my network stopped for a second, and for being here, Ronan and Dan for joining us in the BIVA Forum, Rethinking the Stock Markets in the 21st Century. Your insights and the topics discussed today have been of great value. We hope to have you soon in future events, where we know our audiences will benefit enormously from these rich exchanges in points of view and practical approaches to the topics at hand. Thank you, and we invite you to join us tomorrow in the final panel of the BIVA Forum, Government and Regulation. Thanks all for joining, and have a great week, and stay safe.
Cool. Thank you very much.
Thank you very much.
Thank you.
Bye-bye.
Take care.
Thank you all. Bye.